Welcome to the Behind the Curtain podcast, your real-world guide to real estate investment and property management.
Hello and welcome to the new Real Estate Investor Podcast, created to expose the reality of real estate investing and property management, and to let you hear the experiences and opinions of investors and industry professionals. If you're just getting started in real estate investing, or if you're a seasoned investor with your own journey's experiences, Behind the Curtain Podcast will enable you to be equipped to invest with common sense. Hi, I'm Glenn Green.
Hi, I'm Brett Bernard.
And I'm Aaron Ivey.
In this episode, we'll be chatting with our guest, Mike Gibson, who's an investor based in California. We'll be discussing various topics in our neighborhood chat. And finally, we'll talk about types of investment property and how to decide what is good for you. So turn up the volume, sit back, and listen. So, Michael, you finally figured out the technology?
Yes, I just had to play with it a little bit, and then I got into the back door.
Cool. Well, we were just talking about what an investor should be looking for when they decide to become a real estate investor. And through my discussion with Glenn, I was actually talking about building relationships with those investors and actually getting to know each other on a more personal level than just business. And I was just making the topic that you and I have talked, and when we talk, we typically talk for a long period of time and never discuss anything about real estate. We just talk about politics or family or this, that, and the other. And Mike, my question to you before we get into anything else is, for the people that are going to be listening to this, my issue or my suggestion in Real Estate 101 is, first, find you a good agent that knows what they're doing and they trust. So I want you, and you don't have to pump me up simply because you're on the radio and I can hear you. If you be honest, if I suck, you can tell people I suck at being an agent. But what I want you to do is explain to people, what should somebody look for in an agent? What did you look for when you contacted me?
Okay, so there's multiple facets here. Out of all the agents I've ever dealt with, I see that they're not thorough. I learned that, I think, on my first property I ever bought. It was something to do with the mailbox. And the lady said, "Oh, yeah, we'll take care of it. Just sign this." We closed. She was gone. She never fixed the mailbox. Mm-hmm. So I did it myself. But I think just representing the buyer all the way through, and making sure that, at the end, that the buyers or sellers or both are happy. And I would say, not to really toot on you here, but you are excellent, Brett.
That's what I was hoping for, Mike.
And so, yeah,
it was a baited question.
I would say that, and I don't know why, you guys are different than anybody I've ever dealt with. I mean, there's some pretty decent agents, but I'll tell you this, okay? I would be broke now and be done if I would have found good agents. I mean, literally, and I can go on, but I've told people, hey, I've got X amount. This is what I'm willing to buy up to. Find me something. This is what I'm looking for, our ROI. And people go silent. I found a 5-plex here in California, and I asked a realtor friend of mine I want to see it. And he totally dropped the ball. I never got it. And so that was one of those fish that got away right before the market skyrocketed. But, your average over there is probably like our economy crashing here is probably
Correct.
Where it's at. And so I had, I had money sitting around, and I was waiting for the market to kind of dive. And, it just keeps going and going and going here in California. But, people are leaving the state. And so there's other issues that I have going forward in California. But, meeting you guys was great. And so I was able to get my money out of the bank, which I don't want to keep money in the bank. I want it invested and making me income. And so Did I answer your question?
Yes, you did. You did. You didn't really pump me up the way I expected you to, but that's okay. I'll accept what you said.
No, and it might be that Southern thing. I don't know, but you guys are great.
I appreciate that.
Went great, and you kept up. You with the contractors and all that. That's a big deal, man. I really appreciate that. You didn't stop. You got your commission, and that's a big deal.
Well, here's and just so let me touch on that real quick before we move on. What Mike is talking about is what Glenn and I is part of the formula, and that is number one, we're your partner, we're your boots on the ground. When we find a property that's interesting, we go look at it, we take pictures, we check the neighborhood, we inspect the property, and then if it needs repairs and we're going to negotiate the price based on that, we then get the contractors to get the bids, and then we get them in there to do the work, and then we follow up with them to make sure the work's done. And then we help turn it over to the management company to get it taken care of. Now, normally an agent would be done at that point. They would be, okay, I've done my job. But that's not true. Mike, you bought 3 properties a couple months ago, but we've talked 8 or 9 times since then, and you're not buying anything right at this moment, but we still get on the phone and talk. We still get on the phone and discuss strategy and, what's coming up this year, what happened last year. And
I called you yesterday.
Yeah, exactly. I just told him that. And that was Glenn's point earlier, is that we build that personal relationship so that you feel good enough to pick up the phone and call me at 9:00 one night because you've got a brainstorm that you want to bounce around, you want to talk about of something, maybe your next investment or your next move. And that brings me to the next thing I want to get you to discuss, Mike, if you want to, was our discussion yesterday about your property in California and whether you should do, the 1031 and moving things into Memphis. I want you to discuss that and just off the top of your head, kind of throw it out there if you want to and help people understand what your question was.
So I have the 3 properties there in Memphis. I have a duplex here in California. And, I did good on it. I bought it at the right time and it pencils well. I look at the most efficiency that I can get for whatever I have. So what I do is I look at the equity that's in this and what I paid for it. And yes, it pencils very well, but I see the equity in it. And I know that if I pulled the equity out and came to Tennessee, I could do, 600, 700, maybe even 800, 900 more a month. And so when I look at that, I think that that's almost, it's like that property's done good for a while. But now if I was to, and it has to be a 1031, because if I have to pay the tax on it, I'm going to lose a house doing that, basically. So
Sure.
It has to be a 1031. That's a whole hustle right there, is getting, everything, proper. So we don't have to pay the tax on it. But yeah, so that's why I called you yesterday, because I think I could do quite a bit better by getting out of that property and moving it to Memphis.
Sure.
Or Raleigh.
Well, and I told you, I thought even if you weren't, let's say you decided you want to go buy in Utah, I still think it's a good idea because as we discussed, the rate of return you're getting in California versus what you could get here or somewhere else, it's a no-brainer. You're getting a better rate of return, better cash flow, more income, and you're going to be in a situation where you're not concerned about the property losing value at this point. It should appreciate versus what's happening in California. There's a big chance that unit may be worth, 15% less 2 years from now, simply because of what's happening in California and the state's economy.
In California, especially in the Central Valley, this market has gone. And the weird thing, we talked about this yesterday, I think, is, a duplex can be a $400,000 duplex that still has $800 a month rents. The people that owned it didn't keep up on the rents. So, but they're going to, it's worth $400 or at least they put it out there to see if they're going to get it sold. It's like a 4% return. I looked at something this morning that I look at stuff in here, and it's like a 4.3% gross return. Someone's going to end up getting like 2.5 net. I mean,
right.
Better bank. I understand that's really safe money, but I'm not willing to do that when I see there's more options. So, in my opinion, California as a whole is going to pop. People are leaving the state very quickly. I'm kind of stuck here for a while, but there is a couple other dynamics going on, and I don't know how it's going to affect especially the Valley. We have people from the Bay Area because of the virus. They don't have to go into work anymore, and they can telecommute. So I'm seeing these people come out to the rural areas, and they're bringing their money out here, and they're buying. I'm guessing a large part of them are paying cash for these because they're Bay Area money, and they sold their home and they bought a home out here for half the price. Because the Bay Area, you can't touch anything for under $1 million unless you'd be in Skid Row. So $1 million home, let's say a $2.5 million home, they sell it, they buy a nice $600,000-$700,000 home out here, and they've got, almost $1 million or a little bit over $1 million left, and they're buying a few rentals. And so that's driving our prices up. I think we're close to a massive correction. I think the whole country is going to have a big correction, but we're not isolated here. I think you guys are more isolated because when I see people leaving the state, they're going, well, it was Oregon back 7, 10, 12 years ago, but they have, they have their own issues that are coming up. So, Portland's a big issue. So people are not going to Oregon as much. I hear Idaho, most of the time if people are country folk or they want to go in the mountains, but Idaho has got new issues that are going to come up. So I see a few people going to Utah. Utah is beautiful, very conservative state. But I'm hearing Texas a lot, and I'm hearing more and more people going to Tennessee and Oklahoma a little bit. One of my neighbors moved to Oklahoma, but I can't handle Oklahoma. But yeah, so I would say
neither can I.
I think Tennessee.
You can't handle the state or the musical, or both.
Yeah, I don't know. But I think Tennessee is going to be isolated because I'm hearing more and more people, especially Nashville. So I think it's a very safe bet.
Yeah, I agree with you. And not just because I'm an agent here, but as you learn about the market, especially here in Memphis, we discussed earlier the demographics and the fact that the majority of people inside the city limits are considered blue-collar workers. They're working at the airport, FedEx, Nike, Amazon, and they're not making $100,000 a year. So a lot of them are going to be renting homes, and the rent factor has got to be between $800 and $1,200 a month. You exceed $1,200, and you're going to eliminate a good portion of the rental market in Memphis. But I'm glad you discussed what you discussed, because I do have investors that have properties in other parts of the country, and they've recently been calling me, asking me if I thought it was prudent for them to liquidate these properties before the bust or the correction and bring that money to Memphis and buy 4 or 5 rental properties and increase their income and potential of value increasing. And I say absolutely, not because I want to sell properties, but because it's common sense. You just said you looked at one and the gross is 4.5%, and that'll end up being maybe 2.5% if they're lucky. I mean, you made the point. You can put your money in the bank and get better than that. So what's the point? But with that said, I want to get your opinion on a few things. You and I, Michael, have talked about a lot. We've talked about the economy, the new administration, 2020 versus 2021, what experts are saying, and what I feel with what we see here on the ground in Memphis. So I just want to run through a few questions and kind of get your feedback on it. The first thing I want to have you touch on is, how do you feel about your investments in 2020? I know the only place you bought was Memphis, but you've purchased in other areas. And how do you feel about those purchases right now today? as investments?
No, I'm ecstatic. I was trying to figure out how I can, get more. And I've got 2 ideas, that we're gonna do 2 more waves. I think probably this year, but yeah, having money in the bank and, just if it wasn't for meeting Tom out here and finding out about you guys and, he gave you guys top honors, I would have just been sitting on cash. And so, no, I would say I'm really happy that I've got, more income versus just, cash heavy sitting in the bank.
And what did now that the cash flow's coming in? Now you had to do some repairs to the properties, and we negotiated that into the deal themselves. But right now, what is your projected ROI, rate of return, annually?
Gee.
Do you know?
So no, it's been a little early. I just asked Brenda, my wife. I said, "Hey, did we get deposits?" And she said, "Yep, I see them." And then I asked her 3 or 4 days ago, and she said, "No, it's too early. We need to wait another week." So I don't even know. It's probably in there by now.
Okay. And what is your projected cash flow?
I think we ran the numbers, and it was going to be 10.7. That was going to be net before taxes, and obviously things can come up.
Yeah.
And I might
was that before the expenses? I don't recall off the top of my head. Before the repairs?
Well, so that was if we were to pay full price, but then we saw that there was repairs. I ended up doing basically all the repairs. So I spent $8,000 more on the combined 3 homes. So that changes a little bit. Maybe I'm just throwing off the top of my head. I might be at like a 10.2 or 10.3. But talking to Lindsay in your management office, some of the numbers are a little low. And so I think so 2 of the homes, they're great families. They've been there. One of them's been there over 8 years. I really don't want to mess with them. The other one, I think, has only been in there a year. And then the third one.
Real quick, before you move forward, the one that Mike's talking about, the family has been there 8 years. His point is that the house is rented way under market. It's what's $200 or $300 difference, isn't it? Something like that. So
I thought you told me it should have been $825. Maybe it's $725. But maybe I'm off. Maybe I
think the bottom is $825. The top was $950. So I think the range for me would have been maybe $850, $875 is what it should be. So yeah you're about $125 shorter.
Well, it's very common in the Memphis market for investor property owners to not want to increase the rent for long-term tenants, which is fine, except if you decide that you want to sell it as a tenant-occupied property. If you're going to sell it vacant one day and fix it up and put it on the market, that's fine. But I do have property owners that come to me and they want to sell it with the tenant in it, but they haven't raised the rent in 5 years. And believe me, the rent market has changed quite a bit in 5 years. So that's something to give consideration to.
You're bringing up a good point, Glenn. And that's what's happened here in California. And so to put a flip on it, and I know you guys don't have this, hopefully you never do, but our governor came out and said there's rent control. So you can only go up a combined 5% per year. And then on top of that, you can go up inflation. So inflationary numbers change every year. Let's just say it's 3%. So that means you can only go up by 8%. So if you're in California and you buy a property for full price, but it's still at $850, market when it should be $1,150, you can go up 8% a year. Roughly, it might be a little less next year. How many years is that going to take you to get to fair market or even close to fair market? I mean, you're going to be bailing water out for years, and that's another big issue with California. And I would never hit anybody hard like that anyways. But you're doomed if you buy in California because of that.
So
That's incredible to me, because they're telling you 8% based upon what the current rent is, not the market rent. Is that right?
Yes, they put a cap on inflation for that year, whatever they deem it to be, plus a 5% kicker on top of that. So, it could be 7 to 8%. Unless we have big inflation, then maybe it could be 9 or 10. But even at 8%, and you got an 800, let's say, we'll just round it to 800, that's $64. Now you're at $860 a month. And then next year you go to $920, and then $980. I mean, it could literally take you 5 to 6 years to catch it. But if it's gone already for the next 5 years, it might take you another 2 or 3 to catch it.
Yeah. It makes sense. Well, luckily we don't have those rent controls here. I mean, unless you get into MHA, the Section 8 housing, there's some rules and issues with that. But none of the three that you purchase are MHA. I try to stay away from those as much as possible because they are complicated. But I wanted to bring home the point before we go to the next question, that what you've done in Memphis has produced more than the $400,000 investment you have in California. And I think we bought these for all between 70 and 75 a piece, I think it was.
Yeah, I paid $183, and I think I put 21 in.
Right. And then you've got rental income of around $2,500 a month. Correct?
17, 21, 2275 maybe.
Okay. So people that are listening can take those numbers and just divide them out and get a gross, and then deduct, 2 or 3% off of that for cost. And it'll give you an idea of the rate of returns that you can work towards in Memphis.
Or just say 1% a month, because those are across the board. That's what investors like. So if it's a $200,000 property, you want $24,000 a year.
Correct. Yeah, correct? I mean, and that is a very good point for the new investors that are listening. I want to make sure they understand one thing. A good rule to always keep with you when you're looking for property is use the 1% rule. If you buy it, just like Mike said, for $200,000, it needs to be able to rent for at least $2,000 a month. If it's less than that, then you're dramatically going to change your ROI. We have some investors that are good with that, but most of my investors, their baseline is 1%, and they only do 1% or higher. So when you're out talking to an agent, throw that question at them. Say, do you hunt properties based on a 1% rule? And if they say, I don't know what that is, hang the phone up and call somebody else. All right, so let's move on.
Okay. Mike, based upon your 2020 experience, what do you see happening in the market in 2021? I know everybody's got an opinion, got all these experts out there. What do you see happening in 2021 in the real estate market?
Well, it's only my opinion, and my opinion changes daily.
What's your opinion today?
I think the stock market is going to crash hard. I think our current administration is going to keep putting screws to us, and they're going to send us into some kind of recession. I think we already kind of are because of this virus, but I think it's going to get much worse. People with money are not going to usually be hurt because of that, and that's sad. That the middle class and the lower end people are going to be in trouble, and I feel bad for them. So I think going forward, stock market's going to crash. People are going to take what they have left out of the market. And I'm thinking about this because I've moved my money into money market that's still in my SEP IRA because I'm self-employed. But I'm thinking about paying the tax on it and buying something that's safe. And real estate is one of the safest things that you can buy. And so I saw this last time when the market crashed. I couldn't even really buy any properties. It was hard. I bought that duplex, which I got really lucky on. And I got 2 more homes that I've sold. But people run, and there's some big hedge funds, there's some big players that have multi-millions of dollars that will come into the valley. They'll go after a few realtors and they'll say, if you want this contract, you have to bring me this much of real estate per month or whatever. And so they'll work for them. And the smaller people like myself will have a very hard time getting anything. And so that's probably what's going to happen. It's going to be a big fest for the wealthy to go in and buy up multiple properties. And there's going to be some people that are entry-level investors that are going to probably get wiped out, and they're going to have to sell to generate some cash because maybe they were overexpended in another aspect of their life. But yeah, it's going to be a fading frenzy. I don't know if you saw that back in 09, 010, 011, 12, but out here it was absolutely crazy. I walked in this duplex and there was probably 15 to 20 business cards on the kitchen, and they wanted 119 for it. And I told the realtor 131. And luckily I said 131. We offered 131 or I would not have got it because someone came in at like 130. And so then I put 24 grand into it because it was beat. You wouldn't even want to live in this. I didn't even want to walk in it. But so $24,000 later, and it worked out. I couldn't even rent the place for the first probably year. I was given first month free, and then I had a guy run on me after 2 months. And so, but by 015, 016, things started to work out, and it's turned out to be one of the best investments I ever did. But now I see that the price is so high. You know, we were talking about that earlier, where I think maybe I just get out of it and get the money out of California. And I don't even know if I answered your original question.
Yeah, you did. Yeah. I wanted our listeners, people listening, I wanted them to understand your thought process, that you had property in California. Now that you've purchased in Memphis and you're looking at the difference in the two, you're now looking at California property as it's not a great deal anymore. But before you met me and bought these properties in Memphis, you thought it was a fantastic deal. So I want people to understand that. Listen, if you have real estate in other areas and you want to increase your portfolio, increase your income, increase your equity position, give us a call. Think about liquidating it and reinvesting it somewhere else through a 1031. And if you can't increase your profitability and income on it, then don't do it. But, I can tell you that if you come to Memphis from California, I can assure you we're probably going to be able to at least get you another 2 or 3 or 4% in return on your investment. So,
and Memphis doesn't have the volatility that other markets have. Even when the market turns, Memphis doesn't have those wild ups and downs that you find in New York and California. It's much more stable. Now, on the flip side, yeah, it's safe. On the flip side, you're not going to see 10% appreciation, but that's not what most investors are looking for. They're looking for income, and they're looking for slow and steady appreciation, 3, 4. There are parts of town that are doing closer to 10, but that's not a long-term thing. There's going to be a cap on that. That's the eastern suburbs where everybody enjoys living. So I think the Memphis market is a safer market in the long term for investors.
Yeah, I agree with that. So, Mike, my next question for you is how do you touched on it a minute ago, and I'm not going to ask you to get off on a political rant or anything, but how do you think? Because when you touched on it, it really made me start thinking. How do you think the new administration and what they're doing now with the canceling the pipeline, the loss of jobs? I read yesterday that Shell Oil is planning 9,000 layoffs. How do you feel this administration is going to affect the housing market as a whole and then the rental market? Or do you think they'll have an effect on it, positive or negative?
So I think we can all agree that the left side of politics is more about control, less freedoms, more taxes. And the right side of politics is more about freedoms and less taxes. And so by them tweaking just a little bit, it can hurt a lot of people. Not to go into politics, but I would say that it's going to get more expensive. And so I've watched a lot of videos with a lot of economists. Some say we're going to have inflation. Some say we're going to have deflation because of the purchasing power of the dollar. With layoffs, I'm saddened that there's a lot of people, good people, losing their jobs. And I would never want to make money off someone's heartache. But if they lose their job and these green jobs aren't ready for them, these people are going to have to give back their cars that they just bought and their houses and their toys. We're going to see a lot of that stuff come back on the market. And so it might change the values of properties, especially where, these pipelines are at. I don't really look at it that way. I mean, yeah, it'd be nice if I could, catch the next wave, when it goes down and I could buy properties at 10 or 15,000 less, but I'm not worried about it. In my game now, I'm looking for income because, there's going to come a time where I'm going to want to tap into that and start enjoying life. And I'm self-employed. I don't have retirement. This is a game, I guess. It's I enjoy investing, and not only is it maybe a hobby, but eventually it's going to allow my wife and I to not have to work because she don't really have much of a retirement.
And let me make so the listeners understand who you are. I'm not going to tell any personal secrets, but Mike is not a millionaire. He's not some tycoon living in California in a 20,000 square foot mansion, dabbling in real estate investment and playing the market. Mike is a self-employed individual, just like I am, just like Glenn is. But Mike is smart about how he invests. So Mike, we were talking earlier in an earlier segment that you don't have to be some wealthy millionaire with cash in the bank to be a real estate investor. You just got to pick a good agent and be smart.
I will tell you this. I haven't made over $100,000 in over 15 years. Back in the last boom, I did well. There was 3 years where I made good money, but then I worked literally for free, holding my business together. And it got to the point where I worked by myself. I went from, having multiple people, with subs, I probably had about 28 people. Probably about 4 of them were actual employees, and it was good. And then I went and I literally made, I think I had enough money at the end of the month to pay my gas card. Okay. And so that happened, that lasted for years. And just up until I would say I was making 30 or 40,000 a year for the last few years. But so I would tell anybody that's listening to this, I lived on ham and cheese and scraped change together when I was in my 20s just to get enough gas to go do what I was doing, signs and so forth. I didn't have a golden spoon. I've never gotten any inheritance. I never made large money, but the one thing I have done consistently is work, save, and invest. And so anybody that's listening that doesn't have much, that don't matter. I was just trying to get by in my life, but I always saved a little bit. I bought a house and I ended up selling it because I had some land and I ended up selling that. I bought that on a credit card, by the way. I put $10,000 down.
I've never heard that before.
Well, it was $99,000. I wanted a ranchette and I couldn't afford one. And I found this land. And so living in Merced, I bought it. I bought it for $99,000. I put $6,000 on my credit card to get it. And then at the end of 1 year, I had to pay it off. So I had to give her a $4,000 kicker. So that was 10%, or maybe it was $9,900 or whatever. And so I got lucky with that. That appreciated. I sold that for $270 within like 3 years. And so, yeah, then I bought a house And then I waited 2 years or a year, and I got an equity line. And then I bought some more land out by an airport. And I was one of the first people to buy into it. They didn't even have it curbed or guttered or paved or anything. And then that went up. And then I parlayed that in some other properties and some warehouses. And so, you can buy something and let it appreciate. But when you have a booming economy that's starting, if you can find, and I did this with warehouses too, where I'd put a deposit down right when the real estate sign went up. And by the time they were putting the mortar and bricks on it, I'd tell the realtor, hey, I want out of it. And I mean, that was a golden thing, because you see, once you're almost ready for occupancy, people are like, hey, I could put my shop in there. And so it's a little secret, but people like, hey, I should look into buying this. And then I turn around and sell my option. I double escrowed 1, 2, 3, 4, 5, 6 properties that way, where I never even physically had to own them.
Explain what double escrow is for those that don't know.
Simply put, in layman's terms, coming from me, is where you buy something, and before you take possession and pay for it, close escrow, you sign it off to another buyer. And so I've done that a few times, where these are new builds where I put a deposit down. They took quite a while, and by the time they were ready to purchase, I already had someone else that wanted it. I told my realtor that I didn't need it. I didn't want it. I wanted to go ahead and sell it. And so he went ahead and sold my units, or on another case where it was parcels, where he just turned around and sold it. And so I went into the escrow the day of close and signed off, and new owners signed on. And then I was given the difference in a check.
Okay. So you actually closed on that contract? You actually went through the closing? Or did you assign your contract to somebody else?
I assigned my contract to someone else. I never took full ownership of it.
Wow. Okay.
Well, there's 2 ways that you can do that. A lot of wholesalers do that. They put an option on a property, and then they sell that option for whatever the seller wants plus a $5,000 fee, and they get paid at that when it closes. And there's another way to do it too, which I used to do a lot of this back home in Louisiana when I got started in real estate, is you put a contract on a piece of property, and then you line up a buyer. So in other words, the house they want $100,000 for it. It's worth $140,000. I put a contract for $100,000. I turn around and sell it for $140,000, and then I do a dual closing. And as long as it's a cash transaction, or you're not using federally insured loan money, you can still do that. So at the closing table, I made a gross $40,000 profit. Now, out of that, obviously, I've got my fees and costs to deal with, and I may only net 15 to 20, but I still bought and sold a piece of property without actually writing a check.
That's also a short-term capital gain, right?
Well, I found out later that it was. The IRS was quick to notify me, hey, by the way, this is all capital gains. So, yeah.
Yeah, that's ordinary income if it's under a year, right?
Yes, but this was back in, I want to say, late 90s. So back then it was capital gains, and the capital gains tax was pretty hefty. So I ended up having to negotiate with the IRS and settle that out. So never made that mistake again. But my point about the story was that in double escrow, there are 2 ways for that to happen. I don't know if you don't take title to it and then transfer title, it's not truly double escrow. Correct?
No, if like a wholesaler that's assigning the contract, that probably is treated as ordinary income. Okay. But I think if you do a back-to-back closing, it may be short-term capital gain. I don't know.
Okay. Well, Mike, hey, I appreciate you coming on, man. I really do. And glad to get your insight. I'm glad we're able for our listeners to hear from an average guy who's been a good investor with his money and has done pretty well so far. And also your take on where we're headed and where you think this market's going. I still believe at the end of the day that the market's going to stay strong in Memphis. It's still going to be a good investment market. I'm not sure I don't think that about California, New York, and some other areas of the country, but I think Memphis and some of these areas that are blue collar are going to continue to see investment from foreign investment as well as out of state investment, and I think the real market will continue to grow. Well, Mike, I appreciate your time, man. Thanks for calling in, and we'll talk later and discuss we'll finish our conversation what we talked about yesterday.
Yeah, most definitely.
Cool.
Thank you, gentlemen.
All right, buddy.
Have a great day.
You
Thanks,
too, man.
Mike.
All right.
See ya.
And now, Neighborhood Chat.
So, Brett, I'm sure you've heard about what we're dealing with in property management right now.
All day, every day.
That's right. Yeah.
What's the name of the program?
I'm not going to say that. Unfortunately, I don't want to vilify anything I don't want to get.
I understand. Whenever when I send emails to the office about a question, I always get the same thing back from somebody. Yeah. Oh, that means I got to go into the program, and oh my God, I got to do this, and it's so complicated. So I feel bad now when I ask for somebody to look something up for me.
Yeah. So what we've done is I believe we got caught by a very slick bit of advertising by a software company. And the deal is it's a slick bit of software. And a lot of people use it. It's almost ubiquitous across the property management industry. Everybody knows the name of this company. So it'd be similar to a popular software phone or something like that. You can tell it. So their sales capacity on the front end of the management software to us was excellent. They sold us to believe that the software can do everything.
Call salesmen.
Right. Well, we've learned that now. But what we found out is that the core, the backbone of this software when it comes to property management, which is, by the way, accounting, their accounting system is not flexible. So let me tell you some of the challenges that we've had, because I don't want anybody to lose faith in us over this little. It's a bump in the road. It's a 6-month bump in the road. Okay.
Well, I mean, if you change everything, and as well as I do, you went through a massive change that changed the interior of how your office worked and how the employees produced and how they kept records. And when you go and change things for people like that, or make people change like that, it's difficult. Nobody likes change. Then you have, of course, not everything's going to work the way it's supposed to. So you're going to have the little clicks here and clicks there. Yeah. That's understandable.
Yeah.
But it'll smooth out.
Yeah. So, there are aspects to the software that are actually very enjoyable. And so I do want to give it praise, in case it ever came out, which software we're talking about. The interface for the customer in general, is very good. There are some technical aspects of it, such as a universal search bar is brilliant, and so it's kind of like the Google searchability inside of the software. So that's super duper cool. But what it really comes down to is the problems for our investors is that the statements are difficult to read. And at Enterprise, we really make it a priority for us to do the work, for us to properly be able to account for expenses and the like. So the statements can be read, but they require an interpreter for one of our property managers in order to do that. For our investors that own one house, not a problem. For our investors that own 3 houses, 5 houses, not a problem. But we have several investors that own, anywhere from 20 to 40. Yeah. And those investors require a monthly meeting with us to get through these statements. So to show our commitment to our clients, to prove to them that we are wanting to make their experience as easy as possible. Mm-hmm. That's why we're here. That's why we're paid. We are currently vetting a second software that is used by fewer property management companies here. And the reason it's not as popular is because it's a little boring to the user. It has all the tools, all the functionality that the current software we're working with have, but it looks more like QuickBooks. I mean, let me just get very industry about it. Our current software looks nothing like QuickBooks. Most people who own companies use QuickBooks or something similar to that. The management software we came from in QuickBooks. So the one we're going to be going to, I would say in March or April, the interface is going to be just fine. It'll be dependable, and the investors are going to get what they need and want. So that's really exciting.
Excellent.
Although it's challenging, we're remaining positive. One cool thing that's happening in property management right now is that we're continuing to innovate in our inspections department. Mm-hmm. Our inspections department has been, there are challenges there as well. You know, tenants just don't want you coming back into their house to inspect their house. You know, they're like, sure. Gosh, Dad, you know, I graduated from college. I don't want anybody back in my dorm room again, you know, telling me to clean it up, you know. So one of the things that enterprise property management sells to our investors is the sense of presence in the property. You know, we want our investors to not have to worry about whether or not their property is being abused or not monitored for proper maintenance and stuff like that. And so we do have a great inspections program. The iteration of the inspection program we have right now, which is so fun, is we have hired handymen to perform the inspections, which is brilliant because performing maintenance, you know, on a case-by-case basis is expensive.
Sure.
Right? But what we figured out is, hey, if we have a handyman go in there and do the inspection, he's going to be able to tighten screws, you know, fix very, very small things.
Instead of adding it to a list while I'm there, I'm just going to screw the wall plate back in.
That's exactly right.
Yeah. Or change the light bulb out.
Well, we don't do light bulbs. Anyway.
You don't do light bulbs.
Well, you
just turn it 5 times to the right and you're done.
Is this where how many people take the screw in a light bulb joke came from?
Well, so this last week I got a bill from an electrician for changing a light bulb.
How much was it?
$90.
I'll do you one better. I'm on the road all day. You call me, I'll change one for $50.
$50.
I'll save you $40.
That's really great. Yeah.
I'll even buy the light bulb.
All right. Well, yeah, that's great. So anyway, so I called up the electrician. I'm like, you changed the light bulb for $90. And he said, well, it got sent out because the tenant said the light fixture didn't work. And I said, well, now hold on. The light fixture did work, right? And he said, yeah. I said, why in the world would an electrician go out and check on a light fixture, right? And then change the bulb and then charge me $90. Anyway, that's now a joke, so we don't change light bulbs.
You can cut that out.
Well, I don't think we cut anything out. Yeah, everything stays in. So yeah, the $90 light bulb. So anyway, that's kind of a joke. So inspectors go in now, and they're able to do a few certain things while they're at the house. And if they see anything else that needs to be repaired, they're going to send an estimate to our homeowners. Which
it's perfect.
It's brilliant.
I mean, now, are you also doing the safety inspections too, though?
Yeah.
After, right? Yeah.
So, so the safety inspection is more of an annual thing. And we use Randy here. And Randy's, of course, brilliant. He's a former firefighter. So safety is his number one priority. And recently Randy outfitted an apartment complex that came on with us with fire extinguishers and an escape plan. And he drew it all out himself, laminated it. It's on the inside right by the door of everybody's.
I just saw it the other day.
That's right. You know that building very well.
Unit number 2.
Yeah. So, yeah.
Cool.
Of the investors that I've been working with, I've got 3 or 4 different types. I've got your cash, okay, conventional financing, portfolio financing, and hard money loans. So let's talk about each one. Who would want to just use cash? This is the primary vehicle for my Japanese investors because they're trying to protect their cash because in their economy, they make no interest by leaving their money in the bank. As a matter of fact, in some instances, they actually have to pay to park their money in the bank. So they want a place to put it. In the past, there have been some tax advantages for them by buying real estate and then writing down a portion of that investment, which reduced their annual income from a tax standpoint. So many Japanese would come in here and buy higher priced homes at lower ROI because the real impact for them was the tax advantage. Okay. American investors typically don't do all cash. And here's why. Let's say you've got $100,000 to spend. You can go buy a $100,000 home. Let's say it's renting for $1,000. So your ROI after expenses and everything probably going to be around 8%, 9%, which is not bad. But instead of buying one house with $100,000, the typical investor is going to take a quarter of that, and they're going to buy a $100,000 house and put $25,000 down on it. And then they're going to go get another house and put $25,000 down on it, and another house and another house. Now they have 4 houses for $100,000 apiece. They've got $400,000 in real estate that they're getting a return on investment on with a low interest loan. Now is the best time to do that because right now we have historically low interest rates. You wouldn't want to do that at 8 or 9%, but if you can get a loan at 4%, why not borrow the money? It's cheap to borrow. So that's the more preferred method now. Conventional loan, 25% down, finance the rest. And the smart ones will take the rent revenue, the ROI portion, after expenses, and they'll put that on the principal of the loan to help to pay down the principal faster than they planned on. And then once they get it paid down, they can turn around and buy another home. So over the course of time, over several years, they're paying off these mortgages early so that they can go buy more properties, so that in a 10-year span, they've bought 15 homes. That way, when they get down the road, they've got rent income with mortgages that are already paid off, and now they can live on the rent income. Now, some of them take it a step further. They'll get the mortgages paid off, and now they've got properties that they have equity in. And they'll go to a portfolio lender who will extend to them a line of credit using those properties that are already paid off as collateral. So now they've got another line of credit that they can borrow from to go buy more properties and start the whole process over. So it just depends on how they want to go about it. Now hard money lending is something that flippers do. They're borrowing money for a short period of time, anywhere from 30 days to, say, 6 months. And it's hard. They call it hard money because there's no collateral. They're borrowing money at a higher interest rate from somebody that's going to trust them to pay it back. Now, there's going to be some guarantees in there, of course. But if you're going to borrow $200,000 to do a flip and it's going to take you 90 days, you may pay 8 or 9% annual on that. So if you break that down, that's about, 3/4 of a point per month. And so over 3 months, you're going to have hard money cost. You have to build that into your budget. What's it going to cost me to have this money for 3 months? So it's a part of your budget expense. So hard money lending is not something I would recommend for long term, but for short term, very short term, it seems to be more and more plausible for flippers.
Yeah. So when it comes to hard money lending, obviously the goal with this is there is a real estate project, a flip that they're looking to do, like you're talking about. I've even had friends that have done new construction with a hard money loan or a full rehab, like on the flips that you're talking about. And in that situation, it makes perfect sense to do that. We actually have friends that are hard money lenders. This is such a unique time for a lot of our investors because there are people out there that are literally forming their own banks, because they've made so much wealth. They've seen that a way for them to make some good money is to take that risk to lend $100,000, $200,000, $300,000, at that 8 or 9% interest rate that you're talking about with various fees. And that's how those people are making their money back. So I really enjoyed what you said about the various stages of real estate investment. What you just mentioned is really the dream, for most real estate investors, and that's to start with 1 or 3 and pay those down and be faithful and responsible with those properties and the financing that they've taken out. And then once they've created that equity inside of that property, they're able to then borrow against themselves. they themselves are becoming the bank. They themselves are building wealth in a way that that really only real estate can do. You can't do that with your Roth IRA. Well, actually, I take that back. You can get financing through your Roth IRA.
Yes, you can.
IRA.
You can. Yeah.
But it's not common, and it's very complicated.
Yes, because basically the IRA is the buyer, and the IRA is on the deed.
Yeah.
Because you've borrowed money against that asset, so the asset you're purchasing becomes the property of the IRA.
Self-directed IRA. That's where I was going there. Yeah, and I hadn't planned on bringing that up, but we do have right now several self-directed IRAs that own property, and we manage for that self-directed IRA. Yeah. It's an interesting way to purchase real estate. I'll put it that way. If that works for you, that's great. I don't know if this is true or not. In my experience, the most of the people that are using a self-directed IRA are older than, I would say, age 55. A lot of them are in their retirement age. So they've built up a lot of value in their IRA. And then when they switch it over to a self-directed, and they're able to not only purchase property, but also pay for expenses, throughout the ownership of that property. It's very, very interesting. One of the downsides from a property management perspective is that there is somebody managing that IRA. And so I'm not speaking to Mr., the homeowner. Right. I have to speak to the advisor, if you will, that works for Pensco or whoever owns the IRA or whoever's managing it. So that's a very different type of thing. But the line of credit thing is a big deal. A lot of our young investors, and when I say young investor, I really am talking about people between the ages of 28, 29 at the absolute youngest, all the way up to their late 40s, early 50s. That's generally the age.
You're making me feel good right now.
That's great. Myself included. But that's the age range that you and I get to work with, where people have made money, they have invested it wisely, they're looking to diversify, and once they get into real estate, they get hooked. And so we've seen a lot of these investors that we've worked with for 4, 5, 6 years begin to get into that line of credit. And that is really a different level of financing at that point, wouldn't you say?
Yes, it's a bit more complicated. And quite frankly, there's fewer lenders for that type of activity. When you go, when you talk to local lenders, many of them are happy to do investor loans. But once you start talking about portfolios and lines of credit, that goes to a completely different department. And they're going to take more time to look at the individual to ensure that they can rest assured that it's going to work. Okay. So there's a lot of questions of me as I'll meet with the lender sometimes. And they're asking me specific questions about where the properties are located, the condition of the properties, et cetera. They want quality properties.
They really do. And let's just speak to that really quickly. You and I have both worked with bankers. And what I find with line of credit extensions, is that the bank themselves want to be able to identify with the property. And let me explain to the listener why that is. This is not an FHA loan. This is not a super huge national bank loan where they have no idea where the property is and really aren't interested. This is a local bank that we work with. It's somebody that Glenn or Brett and I have a relationship with, and they, if you as the investor for some reason happen to go under, they want to know that they can take the property back and liquidate it. Yeah. And so
and not lose.
Right. Well, and not be embarrassed to say, oh yeah, on our balance sheet are these 600 properties that are just a blight on the community.
Well, and that scrutiny becomes greater when you're talking about multifamily. Mm-hmm. You start talking about apartment buildings, then there's a lot more questions about where's it located? What's the tenant turnover going to be like? Right. Because that bank doesn't want to be stuck with an apartment building.
No, and we'll talk about that later too, because over the Christmas holiday, I was able to speak to some friends and family who were heavily invested in a lower income part of the city. And there were two, I would say 125 to 150 unit apartment complexes on either side of a street in a very generally impoverished neighborhood. And there was no lending whatsoever that went into these buildings. These were, it was private equity the entire time, private funding. One complex was purchased for between $4 and $5 million. And after all the work was done, was anticipated to be at a value of about $15 million. The point is the banks were not involved.
And didn't want to be.
No way. They are not touching that stuff. So anyway, it's an interesting ball game. In that situation, just to close.
That's higher level financing. It really is.
Oh,
when
absolutely.
you get into portfolio lending and lines of credit based upon, collateralized by other properties that you own, that's a higher level of financing. Yeah. You got to have your head in the game. And your lender's got to trust you, and you have to have a trust relationship with them. I mean, you don't just walk in the bank and say, "Hey, I'd like to get a line of credit. I've got all these houses that I own." Yeah. It's a relationship thing.
So when it comes to financing, one of the big questions that that investors are looking to have answered for them is how do they keep from complicating their financing situation. So to say that more plainly, how can they be sure that every time they go in to finance a property or several properties, how can they be sure that they're not going to trip up on some of the snags that are there? Like, are you aware of any situations that you've had where investors have started the financing application and we're getting close to closing, and then all of a sudden there's an issue with financing? What kind of situations have you seen?
Well, I will tell you that in my experience, if you're working with a local lender here, even though you may live out of state, if you're working with someone local, it's a lot easier for me as the agent and your closing attorney to work with a local lender because we know each other, honestly. We're a small community. We really are like a big, small town.
Oh, yeah.
And so everybody knows each other. So working together, and that process is much smoother. We do work with out-of-state lenders, and if an investor is living in California and has a relationship with their California mortgage lender, that's great too. We can work with them long distance. Where we trip up is when the buyer is using a mortgage lender from the internet. And people do it. And it doesn't work well because I know that if I'm getting a loan and the process starts to get in the ditch, I can go to that lender's office and sit down in front of him and look him in the face. Mm-hmm. When you're getting a mortgage with somebody on the internet, there's less concern for them that you're going to show up at their door. And quite frankly, of those times that we've worked with someone by internet, I would say 60% of the time we have problems. We have delays. Closing gets pushed out. More documentation from the buyer. Oh, yeah. I mean, it just becomes a headache. So my preference is if you've got a local lender that you've worked with that you trust, work with them. If you don't, then we can recommend local lenders here in Memphis that we know, that we trust, that we work with on a regular basis that will provide a much smoother process.
Right, because once again, bouncing back to something that Brett said, we in our circle here, the people that we work with in real estate in order to do our jobs, we all want to remain employed. I mean, it's as easy as that. Yeah. And so I know very well some of the people that you've worked with in financing and also in insurance, home inspection, home repair, contracting. So, and these are people that we've worked with for our entire careers. Yes. And we anticipate that we're going to work together with for a very long time. Well, Glenn, thanks for sharing a little bit more with us about financing. I will say that financing seems very daunting, I think, to the new investor. Say somebody who's very interested in getting involved in a community like Memphis, they just don't know where to start.
The first one is the hardest. Right. Once an investor has gone through the process the first time and they learn what it looks like, what it feels like, it's smooth after that. But yes, the first one for a new investor, it's going to be the toughest. Yeah. But we walk them through it
hold their hand the whole way and make sure it's as smooth as it can possibly be.
Yeah, having watched you all these years, to me, it seems very simple. So to anybody that has questions about financing and the ease that we have in that area, just give us a call. Let us know.
Thank you for listening to Behind the Curtain Podcast, your real-world guide to real estate investment and property management. Be sure to subscribe at BehindTheCurtainPodcast.com. And if you'd like to learn more about Enterprise Property Management's real estate services, please visit us on the web at EPMRealestate.com. This has been a Sound Ideas Group production for Enterprise Property Management, Inc.